All right, team, here we go today. Today we have Miss Tamara Podwalny to talk about USDA home loans and the difference between direct and 502. I'll admit my ignorance. I don't know that I fully knew that there was a difference between the two. So, Miss Tamara, before we get started into the difference between USDA direct and USDA 502, give me a quick overview and recap for those that don't know what USDA is and kind of hit me with the highlights and benefits of what it is.
So USDA is a program that offers zero down in rural areas for low to moderate income buyers. Um, they do have specifications on how much income you can make and where the property is located.
Okay, so location and income are the two restrictions, but the benefit is obviously 100% financing. So $0 down. USDA, is this the same department that gives me the grade A beef and all the other stuff that for my food and all the other stuff?
Yes.
All right, so not only are they doing beef, they're doing home loans. So that's cool. But it's a government-backed program, right, for rural properties. So let's start with the property as the first qualifier. Like how does somebody know if a property actually qualifies for USDA?
So there is a link that they can go to. It's
We'll find it. We'll put it around here, but there is a
yeah,
link that they can go look it up, right? They can
the
put their address
USDA
in.
eligibility website, and it gives you a map, and you just type in the address, and it'll tell you if that area qualifies.
Perfect. So they go in and put 123 Main Street, wherever it is, and it'll say, eligible or not eligible. And just to be very clear, an example is here in Dallas, Texas, in the middle of Dallas, there's not USDA, right? You got to go to the outskirts. You're probably driving, I'm going to guess 30 minutes to an hour on the outskirts. And we'll do that. So I know one other piece that, when you look this up, it's 100% financing and the mortgage insurance, if I'm not mistaken, because it is a government backed program, is typically a little bit lower than quote unquote normal loans as well. Is that correct?
Yes, and it's kind of like FHA in the fact where you have an upfront guarantee fee and then a monthly guarantee fee, but both of those are uh, uh, lower than FHA as well.
So the point that you say, because you are the technician, you were really good at this. It's not technically MI, it's the guarantee fee. So it's the same thing. So for those that don't know, government loans, VA, FHA, USDA, they do have an upfront thing or cost that gets automatically, in this case too, right? For USDA, correct? Shake your head, yes, if I'm right. It gets added to your loan amount, correct?
Right.
And at this moment in time, what is that for USDA? What does that cost for the upfront loan guarantee fee?
1% of the appraised value
Cool.
or
And
purchase
so
price.
okay, so that may change. So just to understand, guys, when making this video, that may change, but it's pretty consistent. I don't think that's changed for many years, if I'm not mistaken. So
Right.
there's an upfront portion, and the same. So for example, FHA calls it mortgage insurance premium, VA calls it a funding fee, USDA calls it a guarantee fee. They're all fundamentally the same thing that gets added to your loan balance. So in theory, you're financing more than 100% of the home. You're buying the home, getting zero down, and then you're adding that fee on top of it. Is that correct?
That's correct.
Cool. And then
And then
the other portion is the monthly piece.
Mhm.
So the guarantee fee, there is a portion that's monthly, but with USDA, it's actually lower. Those factors can and do change on occasion. So we have a calculator. We'll put a link to that somewhere around here too, if you guys want that, and you can look it up. All right.
Right.
Thank you, Tamara, for that. So property wise, you got to make sure it works. But I think the biggest thing that always makes it, not the biggest, but in my mind, one of the more difficult things with USDA, one is finding the home that's eligible in the right area. And two, you said income limitations. Tell me
Right.
about the income limitations, and you can give big picture stuff and round numbers because obviously this may change in the future, but tell me about the income limitations.
So it goes off of all parties in the household, not just people on the loan. So if you're married and your spouse will not be on the loan, their income is considered into the qualifying for being approved for the loan. There's two ways to do it. It may not go in for the underwriting qualifying, but it goes into the eligibility qualifying.
So just to be clear, household income for, and is there an age restriction?
Yes.
I remember you and I, so Tamara's been with me we're coming up on 2 decades, which is crazy. So long, long, long ago. And I'm talking probably 12 to 14 years ago when this happened, when we first started doing more USDAs together. We got bit on one. Fortunately, we figured it out and it worked. But an 18-year-old senior in high school actually had a really good job and was making money. And it wasn't great. I mean, it's 18-year-old money, so it's not like it's hundreds of thousands, but they were making enough to where for a moment that put us in an ineligible category because the household income, mom, dad, in this case, 18-year-old, were making too much money. So the income qualifications, guys, there's actually a limit to how much you can make. If you make too much money, you don't qualify. So
Right.
Tamara, to your point, you got to take in somebody even when they're on the loan or not, regardless of whether they're on the loan, you got to count the whole household income. How do they determine that household income? Like do it tax returns, pay
Yes.
stubs? Like how do I prove that my daughter does or does not have a job?
Tax returns.
Okay.
When
So
you file the application and it's notated that you have a 18-year-old living with you, we're required to pull transcripts to see if any income was filed with the IRS for that person if they're living in the house with you.
So think about that, guys. It's the tax returns, meaning if there's babysitter money and people are paying cash, that most likely, in most cases, I'm guessing won't show up on a tax return. So it's whatever's on your tax return from the prior year. Is that correct, Tamara?
Yes.
So if they see an 18-year-old from the year before made, I don't care, $5,000, right, doing whatever part-time summer job they had, if they make 5 grand, do they have to prove that they don't have the job or that they make more this year or less this year? Is there any way we
Yes.
can get around that? Or is it just hard and fast, whatever shows up on last year's tax returns?
Um, you can get exceptions. Typically, it is hard and fast because we've run into that where people got a bonus last year, but they're not getting it this year. And USDA will make us qualify on that higher proposed amount that they could potentially get, where other programs will say, well, we can't use it because it's not guaranteed this year. USDA is like, no, you got it last year, so we have to go under the assumption that you're going to get it again this year.
Right. So I think the part to make is what you just said, which folks outside the mortgage industry may not know. In the mortgage world, underwriters typically take the worst case scenario. They say, well, if we can't prove that it's going to be there, we're not going to count it. Well, in this case, they're counting it like backwards. They're going to say, I don't care if you made that bonus last year and it's never going to show up again. The reality is they're just going to pretend that it's going to show up no matter what. And then the other distinction is that the eligibility income is what we're talking about, right? They're going to say that you are eligible for USDA based on these numbers. It's not to say that that 5 grand bonus is going to be used for qualifying, because if it's a 5 grand bonus, one and done, USDA is going to use it for the eligibility consideration to can you get USDA versus they're going to say, hey, that's not income you can use to qualify. So they're kind of just smacking you just because they can. So it is what it is. We got to play by their rules. So let's now kind of go into the assets. So income we kind of get, right? There's a limit to what it is. And by the way, give me a ballpark figure for that household income here in North Texas. And I know it changes. We always get updates, I think like annually, but what is it right now? I don't even know. What's kind of that upper threshold of where somebody's going to be?
I think it honestly depends on your family size. So
Well,
the
that's
larger
right. It
the
does.
family, the
You're
more
right.
income you're allowed to make.
So,
And then,
so the
so,
income, refresh my memory. And I'm not trying to put numbers out there that are wrong, but call it like 80 grand ish. Is that kind of normal for a family of two ish, 80 to
um,
90?
yes,
Okay. So somewhere in that 80 to 90 range, guys. And there's a chart. We look it up, how many people are in the house and all that other stuff. There is an income limit that says if you make more than that, you don't qualify for USDA. So this is the challenge. If there's a $1 million home, beautiful, amazing country home out there on acres and acres, you don't get 100% financing through USDA because to qualify for that home, your debt limit or your income is going to be capped at making 80 to 90 as a household for a party or for a household of two. So understand there aren't loan limits. Correct me if I'm wrong, Kim. There's no loan limit,
right.
but you are
Those
going to
are
be
waived.
limited based on what you get and the debt to income that goes with it. So is there a debt to income ratio limit that says like how much they can get with USDA?
Yes.
What is
And
that?
that's very dependent as well on your credit score. Because if you have a credit, USDA says that you can have a credit score as low as a 620. But your debt to income ratios are going to be lower. I think it's 29 and 41. Now, if you have a 640 or higher, you can go up to a 3143. But like
So for
that's
the
like a 42.99. Like it cannot exceed 43%.
I remember getting bid on that long, long ago as well. So the benefit of working with a good loan officer who's been around for a long time, like Tamara, is that you get bit once and you remember it. It's because I remember you and I, and again, I'm talking 14, 15 years ago when we first started doing these and these were new to us. You kind of learn the hard way with some of those in the beginning, but I do remember that instance happened once. I don't know what the result was. I'm pretty sure we figured it out, but nonetheless, So that is really important. For those that don't know debt ratios, when Tamara gives two numbers, because some people hear of DTI and they're like, oh, I know what that is. Look, the two numbers she gave, the front end ratio is how much your housing payment is, your full PITI, divided by your gross income, and that's your housing ratio. So when she says, what was it, 29 over 41, Tamara, was that the number you gave?
Yes.
Right? So 29% of your gross income cannot be more, your mortgage payment can't be more than that 29%. And the second number is the DTI, the total debt to income. And that's taking all the debts, right, that show up on credit reports and everything else. So that is very important to know. And that's,
They
again,
also
what
count
makes
childcare into
USDA
that
kind of hard to
ratio.
qualify, because if the home gets too expensive, then all of a sudden it's hard to qualify for that. So I don't know the exact number. Depends on the income. If you did the math, I'm going to say it's probably three. It depends on interest rates too, right? For how much that mortgage payment is. But I would say in today's world and kind of historically, you're looking at about a 350 ish, maybe 400, I think is on the high side. That's when rates were really low. But I would say that 3 to 350 is probably the upper end from a price point based on those ratios and working backwards.
Right.
So I don't know that for sure. So understand this is my full disclaimer. We can run the math for you. Probably should have done it before I interviewed you, but nonetheless, we're here. So let's talk. Is there anything else that you can think of for income or debt ratios that we need to talk about, Tam?
Um, so in the calculators with USDA, they do give credits to help lower your income in case you make quote unquote too much or you have a 18-year-old who lives with you. There's a credit for medical and childcare or per child under the age of 18 that will help reduce your income if it's too high to make sure that you're eligible.
I
And I
had
want
no
to say that
idea.
it's
That's amazing.
480 for the child credit and then 400 for the medical.
And again, just to be clear, those numbers can change, but the reality is we can give you credit for those things, which I had no idea. That is awesome. This is why you and I have worked together for 15 to 20 years, because you're so good at this. That's awesome. All right. So that piece. Let's go to assets real quick. Tell me more about, I know there's something having to do with the purchaser can't have more than like some percentage of the sales price into the liquid accounts. I think it's like 20%. Is that
I think
right?
it's 20%.
Again, that's the fact that you know this off the top of your head is just amazing. So the meaning, like, give me an example. If it's we'll take a round number. If it's a $200,000 home, 20% of that says
40,000.
$40,000. They can't have more than 40 grand total, or just in a liquid account. What is it? Help me get some of those details.
So I believe that it's in a liquid account, like a checking account, savings account, something like that. Retirements and everything, it's 60% of the vested value that can be used as assets. And I think that whatever that 60% of vested assets also is an addition to whatever you have in your checking account. So they're
So just to be clear, if somebody's not of retirement age, and let's pretend they got 50 grand in a 401k, so a retirement account, and they're not of retirement age, 60% of that is 30,000 bucks. So
right.
that 30,000 bucks gets, and they do that because they want to account for taxes, and they want to account for like penalties if you were to withdraw the money, and then market fluctuations. So that 60% goes towards their reserves. Is that correct? Does
And
it
then
have to
so
do, does it impact that 20% as far as liquidity? Because again, you mentioned the 20% on liquidity for the sales price. That's not part of it, correct? That's separate.
I want to say it is. Now this could be an old thing, but I do remember, I think on the same one with the 18-year-old that we got bid on, this also came up in having too much reserves or too much
So,
liquid cash.
so just to be very clear, guys, Tamara and I both, right? We've both been doing this for a long time. Both of us 20 years in the business, no longer. The reality is, if we are not sure for something like this, like part of being a great and wonderful mortgage person and professional is knowing when you don't know, right? When guidelines change, that like Tamara knows 90% of these things. So if she says, man, we got to check on that, I promise you, the team is smart enough to know when to look things up, right? So I agree with you that I didn't know any of that, to be quite honest. So I was doing my homework, and those are my questions. So that's really good. All right, so let's go back to the original piece. USDA Direct and USDA 502. I thought, what is there any other USDA? I just assume those are the only two, but is there any other? So tell me the difference between USDA Direct and USDA 502, whatever that means.
So the 502 is considered the USDA guarantee, and that's the one that most lenders do. because you have to be an approved lender with USDA, and the application and everything is filled out with the loan company, for example, CMG like us. And then the USDA Direct, that's applications are accepted directly through the USDA Developmental Service Center. You have to apply through them.
So in other words, if I want to be a homeowner, I do USDA Direct. I go straight to USDA. And
Yes.
I didn't know that. I didn't know that was even an option. I can't tell you if it's a good or bad experience. Do you know anything about that as far as like, is there a benefit to doing it directly through the USDA?
Um, so the USDA Direct is more for lower credit. So for those clients that might have that 620 credit and also have low, very low to low income, where USDA Guarantee is for low to moderate income.
So just to put words in your mouth and restate what I think I heard, in a perfect world, the USDA 502, the quote guarantee, I do know that word, so that makes sense. If the 502 is the guarantee, I knew that. So the USDA guarantee is what normal like us lenders can do. And it sounds like if for some reason we can't get it done as a lending community, whether it's us or any lender X out there, that's when somebody can go apply directly to USDA if they feel like they got a good reason
Yes.
for making that loan happen. Is that correct? Because USDA, it's their automated system says yes or no. That's you don't.
Correct.
Can you do a manual underwrite with USDA?
Yes, those debt
Oh,
ratios are very, very tight. You can do a manual underwrite, but then you revert back to the 29-41 debt to income ratios where you cannot exceed it. Doing the manual underwrite, it's very stringent, just like an FHA manual underwrite when it comes to things on your credit report. But getting a manual approved through USDA is very hard.
so think about this. So for those that don't know, in the mortgage world, right, whether it's Fannie Mae or Freddie Mac or the government side, like FHA, VA, there's a system we use. We run it through that system, and the system says yes. And with FHA and VA, you can get an underwriter to say, "Hey, look, we understand the system said no, but here's why, and here's good reasons," and you can overwrite that. USDA has their own, right? Isn't it called GUS?
Yes.
Yeah, I don't even know what the GUS stands for. GUS, it's an acronym for some underwriting system. But GUS
Ginnie
says yes
Mae.
or no. But if it says no, understand that the guidelines just automatically become strict and tight. So there's got to be a really good reason why you're doing the manual, which does, and like I say, if you didn't get it with the approval part on the automated piece where they get a little bit more lenient, it's really hard to get that manual approved. So while you can, it's not normal, and that is the difference in direct.
I said
Um,
Ginnie Mae, but it's guaranteed underwriting system.
That makes total sense, right? That's the guaranteed underwriting system because it's, again, not the direct version. That
Now,
makes total
in the
sense.
direct, you can also, where you have that upfront guarantee fee that you can roll in for the guarantee loan. For the direct, you can actually roll in a few more fees to lower the amount that you have to come to closing with. So you can roll in your appraisal fee, the guarantee fee, your counseling fee, and your credit report and the tax service fee, allowing you to have to bring less to closing.
Damn, I forgot all that. I forgot you could roll all that in. That's amazing.
But that's
So
only with
again,
the
it's not
direct.
everything. It's just what you just said, right? There's certain fees you can roll in. So that way, when you close, you are getting 100% financing, meaning zero down. You're getting the guarantee fee that USA charges rolled in. And then if you want, you can then roll in closing costs, some of the closing costs, the ones that Tamara just mentioned. So technically, when you move in, you're going to owe more than what you probably just paid for on the home.
Correct.
Is USDA only for purchases, or can you do a refinance on USDAs?
You can do a refinance on USDA if you have a current USDA.
So USDA to USDA, you can do a refinance. Cool. And then one other part you mentioned that you said one of the fees that can be rolled in was the counseling fee. So
Mhm.
there's a process they have to go through a homeowner to get USDA. What is that? Is that a 1 hour class or what is that?
It just depends on which one they choose. It's kind of like the ones that are offered for the first time homebuyer programs or the 3% down conventional. Except this has a specific list because it's in a rural area.
Gotcha. So that is something that you need to do. I'm going to ballpark this as me talking, probably about an hour-ish, probably online or something like that, or
They're
web
longer
based.
now. I think they're 3 hours.
Dang, 3 hours. Okay, so you earn it for zero down. You're going to earn it and make sure they do a good job, make sure you're an educated homeowner. So good for them. Good for you if you're getting it.
And it's everybody
Uh,
on the loan.
everybody on the loan, even including, or not include the 18-year-old. It's only if you're on the actual note, if you're putting your name on the paperwork. Got it. Miss Tamara, this was awesome. Again, it's been a minute since I've touched those, and I've forgotten a lot of things and just learned some new stuff. Is there anything else that I've forgotten to ask, or anything we want to talk about?
Upon approval, it's not the purchase price. So if the appraised value comes in higher, upon approval, typically you can roll in up to the appraised value. So you can also roll in some of your closing costs. It's the only loan that allows you to roll in some of your closing costs if your appraisal is higher than your purchase price.
I knew, now that you say that, I knew that, but it's been 10 plus years since I remember. Again, I've been in this. So anybody that knows me well knows that you and I've been together for a long time, and you've far exceeded whatever I ever once knew. I forgot about that. Yeah, that's awesome. So again, this is the only program that I know of, that you know of, that we know of, to where if the appraisal does come in higher, you can actually roll stuff in. That's not normal. This is the only program like that on a purchase that you can do that. Now, refinances, you can do that for normal refis on all the programs. But here, if the value is higher than the purchase price, you then have room to roll some other closing cost in. That's
As
amazing.
long as it doesn't exceed the appraised value plus the guarantee fee. So for example, if you have a home that's 200,000, and it appraises for 210 plus the 1% guarantee fee, that's how much you can roll in.
Wow. Amazing. Miss Tamara, you're incredible. Thank you, thank you, thank you. You're amazing. For all those that need or want more information, you can call us, reach out to us, and reach out to whoever invited you to this thing. But we appreciate you as always. Thanks for joining, learning about loans. Tamara, you crushed it. Have a good day, everybody. Stop once it lets me. Yes.